Hello and welcome to the Basic Tax Course, Session 3. It's time to review the Session 2 quiz. From here on out, we are only going to be reviewing the most frequently missed questions or the ones that we feel need to have some additional information given to you. So let's get started with question 3. Mr. Howard died in early 2012. Mrs. Howard remarried in November of 2012 and is therefore unable to file a joint return with Mr. Howard. What is the filing status of the decedent, Mr. Howard? A, single, B, married filing separate, C, married filing joint, or D, head of household? Correct answer is B, married filing separately. Now let's explain why. This is a rare occasion where your spouse will die and then you will remarry in the same year, but it does happen, so we do cover it. Mr. Howard was married on the day that he died, but during the course of the rest of the year, Mrs. Howard remarried. So by the end of the year, she's married, but she's no longer married to Mr. Howard. So Mr. Howard is not single on the day that he died, so he can't file single. Married filing joint won't work because Mrs. Howard is now remarried and her status on the end of December 31st, 2012 is married but not married to Mr. Howard, so married filing joint doesn't work. And head of household will not work because Mr. Howard does not meet any of the requirements for head of household. So Mr. Howard will be filing married filing separate, and Mrs. Howard will be filing however she chooses to with her new spouse. It'll be married, but whether it's married filing joint or married filing separately, that will be up to them. Okay, let's take a look at number 5. To file using the head of household filing status, the taxpayer must always be able to claim at least one dependency exemption, true or false. The correct answer is B, false. If your qualifying person is your unmarried qualifying child, that person does not need to be your dependent. We can find this in IRS Pub 17, page 25. Let's take a look at this. Here's Table 2-1, who is a qualifying person, qualifying you to file as head of household. Well, right in the first row here, it says if that person is your qualifying child, such as a son, daughter, grandchild who lived with you for more than half the year and meets the other certain requirements. They also have to be single. Then that person is a qualifying person, whether or not you can claim an exemption for that person. Question number 8. Mrs. Setter was divorced on February 1st, 2012. She had a 12-year-old dependent daughter living in her home for the entire year. It cost $8,000 to maintain Mrs. Setter's home for 2012. Mrs. Setter paid $5,000 toward the support of her household. Her ex-husband provided $3,000 in support payments toward the household. According to their divorce decree, Mrs. Setter's ex-husband is entitled to claim their daughter's dependency exemption. What is the most advantageous filing status for which Mrs. Setter can qualify? Is it married filing separate, married filing joint, single, surviving spouse, or head of household? Mrs. Setter's most advantageous filing status is head of household. And let's take a look at why. Mrs. Setter has a daughter that lives with her, but she doesn't claim her dependency exemption. Table 2-1, who is a qualifying person qualifying you to file as head of household? Well, it says here, if the person is your qualifying child, such as your son, daughter, or grandchild who lived with you more than half the year and meets certain other tests, and he or she is single. So in Mrs. Setter's case, she has a daughter, a 12-year-old daughter, that meets the qualifying child requirements. She's single, and you can claim her whether or not you can claim an exemption for that person. Tracy was widowed in 2011. In 2012, she paid more than half the cost of keeping up her home for the year. Tracy also paid more than half the cost of supporting her 12-year-old cousin Mike, who lived with her from February through December. What is the most advantageous filing status that Tracy can legally claim? A, single, B, married filing joint, C, married filing separate, D, head of household, or E, qualifying widower with a dependent child. Well, you might think the answer is D, head of household, but it's not. It's single. And let's figure out why single is the only filing status that is available to Tracy. In order to file head of household, you have to have a qualifying child, and that child would be a son, a daughter, or a grandchild, which Mike is none of the above. Or you have to have a qualifying relative. That qualifying relative must reside in your home for the entire year. Mike did not. He was only there from February through December. So the only filing status that Tracy can claim for the year is A, single. Okay, number 16. Mr. and Mrs. Black are filing a joint return. During the year, they provided more than 50% support for the following individuals, all of whom are U.S. citizens. The Black single daughter, age 21, was a full-time student for 6 months during the summer. She earned $3,800, which was spent on her support. Mrs. Black's cousin, age 12, who lived with them from May to December. Mr. Black's widowed father, age 72, lived with them the full year, and he had gross income of $3,850. Mrs. Black's widowed mother, age 69, lived alone, and her sole source of income was Social Security of $3,000. The Black's legally adopted daughter, age 11, lived with them from February to December. How many exemptions can Mr. and Mrs. Black claim on their return? Okay, first thing let's look at. The question is asking us how many exemptions. So right off the top, we know that we have 2 exemptions, one for Mr. Black and one for Mrs. Black. The Black single daughter, age 21, is a full-time student for 6 months. So in order to be a dependent, if you're over the age of 18, you need to be a full-time student for at least 5 months. And so their daughter meets that requirement. She meets the requirement for a qualifying child. So we do not have to worry about income for her because it does not matter how much she earned if she falls under a qualifying child designation. The Black's cousin, age 12, lived with them from May to December. Well, we just saw in the previous question that a cousin only fits the qualifying relative designation if they lived with you the entire year. So in this case, the cousin cannot be a dependent on the return, and there will not be an exemption for the cousin. Let's take a look at Mr. Black's widowed father. He's not a qualifying child, so we move over to qualifying relative designation. He is the father. They are related, but now we have to look at the gross income. When Mr. Black's widowed father earned $3,800 or more, so he fails the gross income test, and he cannot be considered a dependent on the return, and there will be no exemption for the father. Now let's take a look at Mrs. Black's widowed mother. She lived alone, and her sole source of income was Social Security. So we know none of the Social Security is going to be taxable income, so we don't even need to worry about the income. And she is related, and since it's the mother, remember, a mother or a father do not have to live with you. So she can be their dependent if they provide 50% or more of the support. So Mrs. Black's widowed mother is a qualifying relative, and she will be a dependent on the return, and there will be an exemption for her. So let's look at the last person. The Black's legally adopted daughter, age 11, lived with them from February to December. Well, since this daughter is legally adopted, she is the daughter. It is just like a child being born during the year. They are considered to be your dependent for the entire year. And since she's only age 11, we're not going to be worrying about any income requirements. So she will be a dependent on the return, and there will be exemption for her. So let's think about this. We've got one for Mr. Black, one for Mrs. Black, one for the 21-year-old daughter, one for the widowed mother, and one for the legally adopted daughter. So the correct answer is C5. Question 17. Question 17. Joan paid more than 50% of the support of her daughter Judy, age 24. Judy was a full-time student and earned $3,800. Joan can claim her daughter as a dependent. True or false? The answer for this is false. Judy fails the gross income test. We have to look at the gross income test because she is over the age, she is age 24 or older, not under age 24 and a student. So gross income has to be looked at in this situation. She is no longer a qualifying child. We are looking at her as a qualifying relative. Number 20. A taxpayer's spouse may never be claimed as a dependent by the taxpayer. True or false? The answer to this is true. Let's take a look at Form 1040. In Form 1040, you have a spot to claim an exemption for yourself and your spouse, and then you have this area down here where you claim dependents. So you never claim your spouse in the dependent area. You put their name up here on the top of the return and then mark the exemption for them here on line 6B. Question 24. Social Security received by a child from the account of his deceased father and used for the child's support is A, considered support provided by the mother, B, considered support provided by the child, C, not considered as support, or D, none of the above. If you provided more than 50% of the support for your child, you need to use that Social Security that was provided by the account of the deceased father as support provided by the child. And you can see the reference to this on IRS Pub 17, page 34, under Social Security benefits. Question 25. The Mitchells are filing a joint return. They have two children, Mary Lou, age 8, and Susie, age 21. Mary Lou lived at home all year and was totally supported by the Mitchells. Susie is a full-time student at Oregon State University and earned $4,200 during the year. Susie also received a non-taxable scholarship valued at $4,000. The Mitchells provided $4,500 for Susie's support. Okay, so let's take a look here. The question being asked is the Mitchells should claim the following number of exemptions when filing their return. Let's look at the two children. So Mary Lou is 8. There should be no question there. We are told that Mary Lou lived at home and was totally supported by the Mitchells. So no question on Mary Lou. On Susie, she's age 21, so we can still look at her to meet the qualifying child requirements. We're told that she's a full-time student, so she meets that. And we don't have to look at her earned income during the year because she's under the age of 24 and a full-time student. We're also been told that she receives a non-taxable scholarship, so either way that would not come into play as far as a gross income test is concerned. Now, the Mitchells also contributed $3,000 to the support of Mrs. Mitchell's divorced mother, Mrs. Bedford, who is 65 and lived in her own apartment. Mrs. Bedford's personal income was $3,800, of which $1,900 was Social Security benefits. Mrs. Mitchell's mother spends all of her income on her own support. So when we are looking at whether or not you provide over 50% of the support, we do look at Social Security benefits and see if they were used towards support. It's not like in the gross income test where we are looking at whether or not they made over a certain amount. We are told the Mitchells contributed $3,000. Mrs. Bedford, the mother, contributed $3,800. So in this situation, Mrs. Bedford provided more support than the Mitchells contributed. So even though she meets the qualifying relative, a mother doesn't have to live with you, she provided more than 50% of the support. So the Mitchells, how many exemptions they're going to claim, one for each of the Mitchells, Mr. and Mrs. Mitchell, one for Mary Lou, and one for Susie. So the answer is B, 4. So we'll move down to 26. Jenna Simons, who is single and lives alone, has no income of her own and is supported in full by the following persons. Alma, an unrelated friend, provided $2,400, which is 48% of the support. Ben, Jenna's brother, provided $2,150, which is 43%. And Carl, who is Jenna's son, provided $450, which is 9% of the support. So under a multiple support agreement, Jenna's dependency exemption can be claimed by A, no one, B, Alma, C, Ben, D, Carl, or E, Alma or Ben. So let's look at what you have to have under a multiple support agreement. You have to have at least two people that each provided more than 10% but less than 50% of a person's support. You also have to be related to them or meet the requirements for qualifying relatives. So let's take a look at Alma. She is not related to her, so we need to look at the qualifying relative requirements. And it says if you're not related to the person, then they must live with you as a member of your household for the entire year. Well, in the question, we're told that Jenna Simons lives alone. So Alma does not qualify to claim multiple support agreement. We have Ben, who is Jenna's brother, so he's related to her, does not have to live with her. He has also provided more than 10% and less than 50% of her support. He could claim the dependency exemption for Jenna under a multiple support agreement. Let's take a look at Carl, Jenna's son. So he's related to Jenna, does not have to live with her, but he did not provide at least 10% of Jenna's support. So he is not eligible to claim Jenna's dependency exemption. So the answer to this question is C, Ben. He is the only one in this situation who would qualify to claim the dependency exemption. Question 29. You may be able to claim the child tax credit for your 12-year-old son who did not live with you, provided you can claim him as a dependent and he is a citizen or resident of the United States. True or false? The answer to this question is true. The rules for the child tax credit say that do not require your qualifying child to live with you if you meet one of the exceptions described under residency test in IRS Pub 17, pages 27 and 28. So in this situation, let's just imagine a divorced couple, and according to the divorce decree, the non-custodial parent is allowed to claim the dependency exemption, or the custodial parent could release that claim and allow the non-custodial parent to claim the dependency exemption. In this case, you would be allowed to take the child tax credit even though your child does not live with you. Question 31. Alice, age 18, has a 1-year-old son. Both live with Alice's parents. who provide more than half of their support, although Alice had $4,000 in income from a part-time job. Alice meets all the requirements for her parents to claim her as a dependent. Which of the following statements is true? A, Alice can't claim her son as a dependent on her own tax return. B, Alice can claim her son as a dependent only if she files Form 1040A or 1040, not 1040EZ. Or C, Alice can claim her son as a dependent if her parents choose not to claim Alice as their dependent. Okay, so let's take a look at Pub 17, Table 3-1. Overview of the rules for claiming an exemption for a dependent. So it says right here at the top, you cannot claim any dependents if you or your spouse, if filing jointly, could be claimed as a dependent by another taxpayer. In this situation, Alice does meet all the requirements for her parents to claim her as a dependent. They provided more than half their support. They're related to her. They can claim her as a dependent. Even if they choose not to claim her as a dependent, Alice still would not be allowed to claim her son as a dependent because she did not provide more than 50% support. So the answer is A, Alice can't claim her son as a dependent on her own tax return. Well, that concludes the Session 2 quiz review. It is now time for you to continue on and view the lecture for Session 3.
Alrighty then, as we are ready to begin class today, welcome to our course, Wage, Tip, and Other Income. I actually try to teach in form order, and since the 1040 form begins with wage, we're actually going to begin today's lecture with wage. In fact, let me just pull up the 1040 form here. As a tax preparer, my mind is always wrapped around IRS forms, how they work. And when I'm thinking about tax law, I usually am thinking about how is the law applied to the form. And one of the things I remember about forms and the form's instructions is that the IRS creates the forms to apply the law. And so if you ever have a question about what the law is, can I do something or can I not do something, you should look to the form line, and you should look to any additional forms that might be required to fill out a line. For example, if you're itemizing deductions, you need to fill out a Schedule A, and when you're done completing Schedule A, you'll carry your itemized deductions to Form 1040, line 40. And so therefore, if you have a question about what to enter on line 40, you can read the instructions for Form 1040, line 40, but you would also read the instructions for Schedule A, and then even within Schedule A, you might be required to file additional forms. Today's class doesn't involve learning about a whole lot of forms, but we will be touching on a few different forms today. Beginning with the Form 1040, our class will begin with a discussion of wage income because wage appears on the first income line of the 1040. Earlier, I taught a class called Filing Requirements, Filing Status, and Dependence. And the order of that class was to determine whether or not we even needed to file a return. We then looked at the filing status we would claim on that return, and then whether or not we're entitled to exemptions for ourselves or our dependents on that return. So it stands to reason that the very next line in order, following the order of our series, would be line 7. And so that is the first line that we're going to talk about today. But also today we're going to look at line 8 for taxable interest, line 9 for dividend income, and we're going to move on with the first topic of the day, which is wage income. And wage income should be the simplest of all of the different types of income to be reported on a return. But even the concept of wages in and of themselves can cause confusion. It can cause confusion for the tax preparer. It can cause confusion for the taxpayer. And it can cause confusion for people who are employers and have employees. So I felt that the best place to start a discussion on wage income is to actually define what wage income is. Very often as a tax preparer, we're faced with situations where something doesn't look, feel, smell quite right. And what I mean by that is we have a client in front of us that has a document indicating they have a particular type of income, but everything we know about tax law says, but wait, you shouldn't have been given that document. In other words, what you've been given is wrong, and here's why it's wrong. So not only do we need to know that information for preparing the tax return of an individual, we also need to understand that information if we're giving business advice to a business client who perhaps even has employees. So although this is a session on what to enter on line 1, it is also a session about when a W-2 is created, the income that is reported on a W-2, why it's reported on a W-2. So at the very beginning, who is an employee? An employee is a person who performs services under the direction and control of an employer. Remember this simple rule of thumb. If you are told where to work, when to work, and how to work, then you are probably an employee. Remember the old adage, if it walks like a duck, talks like a duck, sounds like a duck, then it's probably a duck? Well, that's the same adage for an employee. It does not matter if you work from home, use your own tools. What matters is whether your employer controls the method and manner in which you provide your services. And here's some illustrations just mainly meant to highlight when we have an employment situation and when we don't. Let's look first at you work for XYZ company as a secretary. You are told what hours to work and how and where to perform your services. You are an employee and your employer should withhold taxes and issue you a W-2. Now, believe it or not, I've actually had tax clients come to me who have been given a 1099 miscellaneous by their employer because they only worked in that employer's office part-time as a secretary. So it doesn't matter whether you're in an office part-time. It doesn't matter whether you only worked there a day. What matters is that while you were there, you were under the direction and control of your employer. Regardless of the agreement that you might have with an employer, typically when you show up at their office and begin doing work for them, you are their employee. But even if you were doing services from home, it could very well be the case that you are considered to be an employee. Let's look at another illustration. I'm trying to come up with an illustration in this second example where maybe a secretary perhaps could be an independent contractor, and you can see that it takes a lot of conditions to turn an employee into an independent contractor. So here's a way that that could happen. So we're assuming the same as for illustration 1, except you are self-employed as a secretarial service provider. You market your business to many different clients. You employ a staff of secretaries whom you send to work at various companies. So you yourself actually have employees. You have control over where and when you work, and sometimes you perform secretarial services for your clients when one of your own employees calls in sick. Because you are in control of your own business, you are not an employee, you are self-employed. When I was very first out of university looking for my first jobs, I did take jobs with temporary employment agencies, and they're very good at finding day-long positions or two-week-long positions for their workers. And in a situation like that, I was not an employee of the company I was performing services for, but I was an employee of the temporary employment agency that I worked for. They paid me W-2, of course, and did tax withholdings and so forth. Number 3, you are a nanny. You are responsible for the care of 2 children at Mrs. Jones' home. You report to work 3 days per week. Mrs. Jones tells you how to care for her children and when to care for them. You are therefore an employee of Mrs. Jones, and if she pays you $1,700 or more for the year, she is required to give you a W-2. Now, I do have a little bit of an asterisk here next to the word $1,700, and the reason is that the $1,700 rule about if you get $1,700 of wage, then a W-2 is required, that applies only to household employees. Anyone else who works even 3 minutes and has $1 of wage is supposed to be issued a W-2. So it's only in the household employee situation that $1,700 of wage can be paid before the W-2 is required. And that's simply the government's method of making sure that if you happen to hire a babysitter to come watch your kids for a few hours each week, or you hire the neighborhood boy to mow your lawn, that you don't end up in a W-2 situation every time you hire someone from around the neighborhood to help you. But number 4 is an example where we do in fact have an independent contractor. Tax laws are pretty specific. If a nanny comes to work for you in your home or provides child care services for you in your home, you have an employer-employee relationship. But the law also specifically states that if you take your children to the home of someone else, then you have an independent contractor situation. So in example number 4, we're assuming the same as in illustration number 3, except you run a daycare business from your own home, and Mrs. Jones brings her 2 children to your home 3 days per week. You are deciding where and how to care for these children, and therefore you are self-employed. When you get a job, one of the first things that you should be asked to do when you take up that job, begin working, is your employer should be asking you to complete a W-4. And the W-4 is telling your employer the tax rate of withholding that you want to see. Now, I can remember the very first job I had where I had to fill out this W-4. I was in a state of panic. I was actually from Canada. This was my first American job. I'd never seen the form before. I called my husband up in a panic, and I said, I don't know what to do. I don't know what to do. And he said, check married and enter 2. But I'm reading the instructions, darling, and it doesn't say to do that. He said, just ignore the instructions and put married 2. Now, this was back in 1990, and back in 1990 you could get away with claiming married 2 when both you and your spouse were working. Today, if you tried that, you'd definitely end up owing. But back then, actually, he and I ended up breaking even with that particular status choice. But today, the withholding rates are not withholding at as steep a rate as they did back in 1990. And people do need to be very careful about what they check here. Now, the W-4 has a series of worksheets. You can see we have one here on the front page of the W-4, and then we go over to page 2 of the W-4, and we have another worksheet here, another to-earner worksheet or multiple job worksheet, and then we have these tables at the bottom. Well, I would put this or classify this as a fairly complex form. If you're sitting there trying to read the instructions and fill this form out, it's no wonder that the average taxpayer goes into a tizzy, blanks out, and starts asking other people what to do because they can't figure out what they're supposed to do themselves. So they may ask a neighbor, they may ask their boss, they may ask their tax preparer, what am I supposed to put on here? And since this is a fairly common question, I pretty much have my answers spelled out. The first thing we need to understand is that the table where you click single, if you're thinking about the single filing status, single and one exemption means that I am going to file a tax return as a single person and I'm going to be allowed to claim myself. Another thing to remember is that if I check married, it means I'm going to be able to claim the married filing status, twice the standard deduction of a single person, and up to 2 exemptions when I file my return if I'm filing joint. Because there's so much greater deduction associated with the married status than there is with the single, checking married automatically means the tables are going to withhold at a reduced rate. That's all well and good as long as my spouse doesn't also work, because if my spouse works and I work and we both check married too, essentially it means we both get the deductions of a married couple and we both get 2 exemptions. Well, we don't really get 2 times the married deduction, and we don't get 2 times 2 deductions, do we? We get 1 married standard deduction, we get 2 exemptions. So therefore, when I have a married couple, my explanation to them is, hey, married gives you twice the standard deduction of single, and if both of you are working independent jobs, then the safer thing to do is for each of you to claim single and at most 1 exemption. And if you want to move up from 1 exemption, it means you have to have extra deductions that are going to be available to you on your tax return. Well, each exemption is the equivalent of a dependent. Do you have any dependents? How many dependents do you have? If you have 3 children and you're not married, you're going to be easily able to claim single 4, 1 for yourself and 1 for each of your 3 children, right? And if you have the earned income credit, if you have the child tax credit, if you own a home, you might be able to claim significantly more exemptions. But all of those are things that we know as tax practitioners about how tax is ultimately calculated on a tax return, and does the average person looking at the W-4 understand how those calculations are going on? So very often I will sit there and I will figure out the equivalent of how many exemptions my client gets to claim on their finished tax return as they're filing it, and that would be the amount that translates to this form. But if your client just wants to play it safe, they're working 1 or 2 jobs, single 0 is going to definitely maximize withholding and probably put them in a situation where they're going to have something of a refund, hopefully not owe. Single 1, that's safe if they work only 1 job, but if they work 2 jobs, single 1 can get them into owing. So those are the types of advice that I give. Let's move on to the W-2 now. And just back up on the manual here, there is some additional information about W-4s, but I'll leave you to read that on your own and just move over to the Form W-2. The Form W-2 is a form that we obviously see a great deal of. It's the most common form our clients are going to bring into us. That probably in 1099-R. During the last recession, I would say the 1099-Gs for unemployment were pretty darn common there for a while too, but just in general, W-2 is the most common form that we see. And there's certain boxes on the form that we should be relatively familiar with, but just in case you're not, we are going to be taking a look at these one by one. And I'm just going to start up at the top with when is a W-2 even issued? Most wage income is reported on the Form W-2, and there are a number of important facts that you do need to know about the W-2, beginning with the fact that all compensation that you receive for services you provided to your employer during the year should be reported on your Form W-2. By law, all employers are required to issue W-2s to their employees by January 31st. It's not uncommon for early bird filers, that is people early on in January, wanting to file as soon as they possibly can, especially if they're expecting a refund. If IRS starts e-file on January 15th, normally the filing season begins about the middle of January in terms of IRS being able to accept tax returns. And so early in the tax season, there are filers who want to file but cannot file because they don't have their W-2s, and sometimes they're kind of upset about that. How come my employer doesn't have it? Doesn't the law say that he has to give it to me? And the answer is, by law, the employer has until January 31st to get that W-2 in the mail. And employees are required to wait until they get their W-2 to file. However, if a W-2 has not arrived by February 15, it is possible to file without a W-2, but you would need to attach a substitute W-2 to the tax return, and on that substitute W-2 you explain all of the efforts you made to get the correct W-2 and how you arrived at the numbers you've entered on the substitute W-2. So your employer has until January 31 to issue the W-2. You are not allowed under the law to file without a W-2 until February 15th. If February 15th comes, you don't have the W-2, you've made efforts to get it, can't get it, then you can file with a substitute W-2. Number 3, when issuing a W-2, an employer does normally mail 3 to 4 copies of the form to the employee, but increasingly I am seeing situations where employers are telling employees that they need to go to their employee account and download the W-2. The employer also submits a copy of the W-2 to the Social Security Administration, and that submission to the Social Security Administration typically happens sometime either by the end of February or the end of March. It just depends on whether they're filing paper or electronically, and they're allowed extra time when they go electronically. But then Social Security has this information, and actually IRS doesn't. IRS is pretty much working on an honor system. When people file a tax return and say they have a W-2 reporting a certain amount of income, the IRS is not able to verify whether or not they actually received that income or had that level of withholding until several months later. And the reason for that is that there's a delay from the time the W-2 is issued by the employer to the point where the information is transmitted to the Social Security Administration. And then once Social Security has the information, there's another delay until Social Security forwards that on to the IRS. It used to be the case that the time frame where we saw IRS actually get the information from Social Security and then match it against a tax return was up to 18 months from the filing date. So if there was an error on a tax return, in other words, a mismatch between information reported on a tax return and information reported on a W-2, that IRS was not notifying the taxpayer of that discrepancy until possibly as late as August of the year following the year that the return was filed. So pretty much what that means is in August is when we would expect most people to be receiving what we call a CP2000 letter based on their 2011 tax return that was filed last year. Now IRS is working on speeding up the process. It does seem that it happens a little bit more rapidly each year, but I don't really have a specific time frame for you and how fast they're doing it these days. Now, number 5, Social Security records information on the W-2 into its files. The reason the information is transmitted to Social Security is Social Security is charged with tracking the amount of Social Security income that you will be entitled to when you are able to draw on Social Security. So the W-2 is transmitted to the Social Security Administration, and they're charged with tracking how much Social Security tax is being paid in. Then when the Social Security Administration is finished doing its deal, it sends it to IRS, and of course it can take IRS up to 18 months to do any kind of a match on that. Here is the W-2, and we're going to be talking a little bit about the information that gets reported in each of the boxes that you see on here. And I'm not going to talk about every single box with you. That would be rather dull and boring, but I will point out some of the important ones. Obviously, clearly, box 1 is where income is reported, and that is taxable compensation of the employee. It includes wages, tips, and other forms of compensation. So whether you're paid on salary, whether you're paid annually, whether you're paid a sign-on bonus, whether you're paid an end-of-employment package, whether you receive free gifts from your employer, and I just put brackets around the concept of gift. Whether or not you're receiving those things, the IRS considers nearly all of them to be a form of compensation that is reportable in Box 1. Box 2 is, of course, where federal income tax withholding is entered, and it is the employee's responsibility to tell the employer what rate of withholding to put in that box. And Box 3 is where Social Security wages are entered. Not all wages are subject to income tax. And so it's very common for some wages to be subject to Social Security tax, but other wages not to be subject to income tax. A good example would be where you've made a salary deferral to a 401k plan. The 401k contribution is exempt from income tax, and therefore it would be a reduction to the amount appearing in Box 1, but it is not exempt from Social Security tax, and therefore the Social Security wage box will be higher than Box 1. And there are certain situations where Box 1 can be higher than Box 3, but normally it's Box 3 that's higher than Box 1 at the lower income levels. But there is an actual cap on the amount of wage income that is subject to Social Security tax, so when you hit that threshold amount, which is indexed for inflation each year, then the Social Security box maxes out and it doesn't go any higher, and then the wage box will continuously pull ahead. Here is the amount that goes into the Social Security tax withheld box. We just finished mentioning Social Security wages, and now we're looking at how much Social Security tax is withheld. You are required to pay Social Security tax on the 1st for 2012, $110,100 of your earnings. Now this number, the amount of wage you have subjected to Social Security tax, goes up every year by approximately $2,500 to $4,000. So it's a significant increase each year in the amount of wage that is subject to Social Security tax. So there's no fixed amount that you'll ever max out on Social Security for more than a year, because each year the amount does go up. But until you max out on Box 3, Box 4 is going to be going up as well. But Box 4 should always be the same amount, percentage-wise, and for 2012, that's 4.2% of the amount entered in Box 3. So if your Social Security wages hit $110,100, then the maximum amount of withholding you would have would be 4.2% of $110,100. And another way to look at it is, let's just simply say, oh, my wage income for the year is exactly $10,000. Then you would have $10,000 of Social Security wages, and 4.2% would be $420 that gets entered in Box 4. Now, we have been on a payroll tax holiday for 2011 and 2012, where the Social Security rate of withholding for the employee's portion of the Social Security tax has been reduced by 2 points to 4.2%. That payroll tax holiday has ended for 2013, and I can remember throughout this tax season my customers commenting to me, gee, my taxes sure went up this year. They were definitely noticing that their rate of withholding at 6.2% was significantly more than 4.2%. And yet, it's been 6.2% for more than 20 years. So that was just a one-time deal for 2 short years that we did get that payroll tax holiday down to 4.2%. And of course, the employer is also paying a matching amount into the Social Security fund for each employee, and that employer matching portion is 6.2%. So the employee is responsible for 6.2%. The employer is responsible for another 6.2%. That means that the total Social Security tax is actually 12.4%, and the exception to that has been 2011 and 12, where there's been that payroll holiday taking it to 4.2%. Box 5 is where Medicare wages and tips are reported, and Box 5 really has no limit. All taxable compensation of the employee typically is subject to Medicare tax, and it never caps out. So if you're earning $1 million of wage, you're going to see $1 million in Box 5. And then the rate of withholding on the Medicare tax is 1.45%. Both the employee and the employer pay 1.45%, so it means that the true Medicare tax is 2.9%. Now, this is a 2012 tax law course, but I just wanted to kind of point ahead to 2013. It's not anywhere in the manual. 2013, the Medicare tax is increasing, but only for individuals who are higher income. And I believe on a married filing joint return, that threshold amount is $250,000 of wage income. On a joint return, if the wage income hits $250,000, there is an additional 0.9% Medicare tax that will have to be paid. There's also an additional Medicare tax that will come into play for investment income, which is 3.8%, but that won't appear anywhere on the W-2. It's going to be an additional tax assessed at the time a filer files. So I'm kind of looking forward to seeing what the 1040 for 2013 is going to look like, because we're going to have accommodation on that form for assessing additional Medicare tax. but only employees who are currently working for an employer with a W-2 that has over $200,000 of wage on the W-2 are going to see an additional withholding amount for the Medicare tax. Most people who do not have a single W-2 pushing them over $200,000 or hitting $200,000 by combining W-2s, they're going to have to pay the tax at the end or kind of account for that by having more withheld in the income tax box. The next box we're going to look at is the allocated tips box and the Social Security tips box. You can see we've got line 7 Social Security tips, and then we have box 8 allocated tips. We're going to be talking quite a bit about tips today, and the main thing to know about tips is that if you work in, let's just say, a restaurant where tipping is customary, if you're a server who's receiving tips, you're supposed to collect that tip, and very often it's by credit card, so you're not even holding the cash anymore. But whether you receive that tip by cash or credit card, you are required under the law to report that tip to your employer. And when you do that, your employer will include the tips you've received in your Box 1 wages. So what you'll essentially have is, let's just say, an hourly rate where maybe your hourly rate of pay has taken you to $10,000 for the year working for a particular restaurant, but during that same year you also received $10,000 worth of tips, and you reported all $10,000 to your employer. What you would have is $20,000 of wage income in Box 1, $10,000 of Social Security wages in Box 3 because that's your normal base wage, and that you also collected another $10,000 in tips, and so Box 7 will show your Social Security tips. Now, if you work in a restaurant and you are not reporting at least a minimum amount in tip, it's possible that your employer will allocate tips to you, and we're going to spend some time talking today about what happens when tips are allocated and why they're allocated. Moving on to the next page of the manual, I've got the next segment of the W-2 that we're looking at. Box 9 is all blacked out. That used to be where advanced EIC was reported. The advanced EIC is no longer allowed, and therefore the box is grayed out. Box 10 is a number that frequently has a number in it, but not frequently enough if you ask me. The reason I say that is we are creatures of habit, we tax preparers, and we're pretty good at looking for numbers in boxes 1 and 2 and down on box 16, 17 where the state withholdings are going on. But these other boxes that sometimes have a number in them but most of the time don't, it's easy to miss those. So I do try to train myself as a tax preparer to stop what I'm doing and specifically look at other boxes on the W-2 to make sure I'm not missing an important entry. Dependent care benefits is an incredibly important number because if you miss entering that on the tax return, guaranteed your client's going to get a CP2000 letter from the IRS saying that there's an error on their tax return or a mismatch on the tax return in the W-2. So what's the purpose of Box 10? Well, Box 10 shows the amount of child and dependent care benefit that an employee received from his or her employer. The child and dependent care amount that appears in Box 10 is either a reduction to any child and dependent care credit that your client will be allowed, or it is an addition to wage income. So if your client had dependent care benefits showing in Box 10, but they had no allowable child care expense, the number in Box 10 will actually add to their wage income, and it ends up going on line 7 of their tax return. But if they did have dependent care expenses, then you need to attach Form 2441 to show the child care expense that they paid. Now, a preparer who doesn't really understand what the law is might just say to the tax client, okay, well, you've got dependent care benefits in here, and the client says, yeah, but those aren't taxable because I paid all of the money out in child care. And that's true. But the tax return has to acknowledge that payout by attaching Form 2441. And if you don't attach the 2441, again, you'll get a CP2000 letter. Moving on down to Box 12, you can actually see we have 12A, 12B, 12C, 12D. These boxes are used to indicate or describe certain amounts of income that that employee has received. Numbers that appear on Box 12 may reference taxable income. They may also reference non-taxable income. For example, Box 12, if you put a code in there, which is a code D, that means that the employee reduced their taxable wage by making an elective salary deferral to a 401k plan or a pension plan. And if there is a code V in Box 12, then it means that that employee exercised non-statutory stock options during the year. Well, when I see a code V on a W-2, I'm going, okay, this employee has wages that are reported in Box 1 of the W-2, right here. Whatever is in Box 1, a portion of the number in that box is because of the exercise of non-statutory stock options. Today's class is not about statutory stock options, and in fact, if you want to learn about those, come back for my class on basis of assets and sale of assets. We talk quite a bit about those there. But seeing a code V here automatically tells me that box 1 is comprised partially of wage, but it's also comprised of wage that comes from the exercise of statutory stock options. Now, the confusing thing about statutory stock options is that many employers will do the exercise through a brokerage house, and that brokerage house will then issue a 1099-B or brokerage statement to that employee. And so the employee will then need to attach a Schedule D to their return with the accompanying 8949 to acknowledge the fact that stock was sold. But the tricky part is not all employers do that, and the law does not require an employer to do it. So a code V could mean that you're expecting a 1099-B, and if there is a 1099-B, you need to address it. But it could also mean that there is no 1099-B because they're not required to issue it. And I find about 70% of the time the 1099-B is issued, and about 30% of the time it's not. So it should have your alarm bells working. So moving on to the next box, we have statutory employees. There are a series of check boxes on box 13. I've just pulled out this one box alone just to kind of highlight it. You can see we have box 13, statutory employee, we have retirement plan, we have third-party sick pay. If you have an employee who has the retirement plan box checked, and this is very common, I would say most W-2s have the retirement account box checked, that means that they are eligible to participate in their employer's pension plan. It doesn't mean that they are participating, but that's not what's relevant. What matters is that they are eligible to participate. And if an employee is eligible to participate in their employer's pension plan, their ability to claim tax deductions for contributions to an IRA account may be limited. Whether or not they're limited depends on how much income they make and their filing status. And we do talk about that in our course called Adjustments to Income. But just from a summary standpoint today, if this box is checked and your client makes a contribution to a traditional IRA, they may be subject to a phase-out on their IRA deduction. The statutory employee box, when that is checked, it means that the client is probably a statutory employee, and the relevance of that is that they are allowed to claim their business expenses on Schedule C rather than on Form 2106. And of course, the difference between Schedule C and 2106 is huge. If you're allowed to claim expenses on Schedule C, you are still allowed to claim the standard deduction. Your deductions are not limited by 2% of your income, and you don't have to exceed your standard deduction to begin to itemize. So it's all the difference in the world being able to claim expenses on Schedule C rather than 2106, but in order to do that, this box must be checked. The types of employees who could have that box checked include drivers who distribute beverages other than milk or meat, vegetable, fruit, or bakery products, or who pick up and deliver laundry or dry cleaning if the driver is an employer's agent or is paid on commission. Also, full-time life insurance sales agents whose principal business activity is selling life insurance or annuity contract or both, primarily for a single insurance company. Also, an individual who works from home on materials or goods that are supplied by the employer. That could be a person who is a statutory employee. And finally, a full-time traveling or city salesperson who works on behalf of an employer and turns in orders to the employer from wholesalers, retailers, contractors, or operators of hotels. Essentially, if you are a salesperson, you only sell for one company, you have an independent type of contractor status, but under the law you are still considered to be statutory for purposes of Social Security and Medicare tax, you could have a situation where your employer is holding Social Security and Medicare tax for you, but is not treating you as an employee in any other way. And if that's the case, then you are allowed to claim your expenses on Schedule C rather than 2106. Moving on, we're going to talk next about Box 15. This box is used to indicate what state wages are attributable to. Now, the state that the wages are attributable to is the state in which services were performed for the earning of those wages. For most people, you live in the same state you work, but it can be the case that you are a resident of a state other than the state in which you work, and sometimes it's the case you work for an employer who resides or is located in a different state than the employee. And I frequently see errors on the employer's part about what code is entered on the W-2. For example, if you worked in Virginia and are a resident of Virginia, Your employer based in New York should indicate that you have Virginia wages. But if the New York-based employer, instead of putting a VA on your W-2, puts an NY on your W-2, then what that's telling you is that your employer did tax withholdings at the state level and sent them to New York. Well, New York should not be collecting taxes for wages earned and attributable to Virginia. Virginia wants those. So really, it's the employer's responsibility to get that correct, but very often employers simply get it wrong. I've even seen payroll services get this wrong, so it can be a problem. But if you have an employee who has W-2 state wages paid to the wrong state, then one of two things should happen. Either get the employer to correct the W-2, refund the state withholding, or have the employee file a tax return with the state that they did not work in simply to get that tax refunded. But it is the employer's responsibility to get that correct. It should not be the employee coming along later and fixing it. Still, I usually find when there is an error that's been made, the employer puts their hands in the air, shrugs their shoulders, and says, hey, I'm not going to deal with it. So then we end up with a state return. Password number 1 is Aragorn. A-R-A-G-O-R-N. Let's move on now to a discussion of fringe benefits. Federal law provides specific treatment to employee wages. Employee wages are generally subjected to a variety of taxes, including Social Security and Medicare tax, and at the employer level, they're also subjected to unemployment tax. Because employee wages are subjected to taxes at both the employer and the employee level, there is an incentive for both the employer and the employee to maybe try to circumvent or skirt the employment rules. Some of the ways that they try and skirt these rules are by giving what they consider to be gifts or fringe benefits, that because they're gifts and not money in the form of a check or cash, maybe the payroll laws don't apply to these. But of course, there's people sitting in rooms all over this country who have been doing this for a long time and are way smarter than me or any of us in this class today, who've pretty much seen everything that there is that could possibly be done to try and circumvent payroll laws, and they've come up with rules to eliminate that many, many, many years ago. It's pretty hard today for someone to come up with an original idea that the tax laws do not address, and fringe benefits is certainly one of those. So employers simply are not allowed to just give tax-free things to employees and not include that as employee wage. Taxable wages that an employee can receive include salaries, vacation allowances, bonuses, commissions, and fringe benefits. It does not matter how the payments were measured or made to you. All of the following payments are considered to be wages paid, and your employer should include these payments on your W-2 and withhold income, unemployment, Social Security, and Medicare taxes. These include amounts an employer pays to you as a bonus for signing or ratifying a contract in connection with the establishment of an employer-employee relationship, essentially a sign-on bonus. An amount paid to you for cancellation of an employment contract. Payments to you to relinquish your contract rights. And compensation paid to you after you ended your employment if you performed duties while you were still employed. So let's just say you are working on commission for a particular employer, you make a big sale, and then you quit or get laid off, and it takes a month or two for that final commission check to make it to you. That final commission check should still be treated as a wage, even though it happened substantially after you left. Taxable fringe benefits. A fringe benefit is a form of pay for the performance of services, and fringe benefits are taxable and must be included in the employee pay unless the law specifically excludes that particular fringe benefit from pay. You generally must include fringe benefits you receive in your income unless the benefits are considered to be or treated as non-taxable. And the following are examples of fringe benefits that are fully taxable. Free use of a company car. Flights on aircraft provided by your employer, free or discounted commercial flights, vacations, discounts on property or services, memberships in country clubs or other social clubs, and tickets to entertainment or sporting events. Now, memberships in country clubs or other social clubs, that used to be a pretty common thing. Back in the 80s, the 70s, that was a really common thing that employees would receive that as a tax-free fringe benefit. But the ability to receive that as a tax-free fringe benefit disappeared under Clinton. I can remember the demise of that particular benefit. There was a lot of discussion on it in the news networks at the time. We're talking the early 90s, that particular fringe benefit became taxable. And finally, tickets that an employee may receive to entertainment or sporting events, those are also a taxable fringe benefit. So what you'll see is, let's just suppose you've got an employer at Christmas time, and they want to give all of their employees tickets to an event. And let's say that that event costs $100. So the employer gives the employees tickets to an event, and the event costs $100. Well, what that employee should see happening is that their W-2 is going to get grossed up by $100. There's going to be Social Security tax withheld. There's going to be income tax withheld. So the employee is going to basically pay tax on that fringe benefit. That's what the law says needs to happen. Employer paid or reimbursed moving and living expenses. One of the common things that an employer will pay for an employee historically and even in modern times are moving expenses. And again, during the Clinton era, moving expenses used to be much broader. There was a much broader range of moving expenses that could be deducted, but you had to deduct those expenses on Schedule A. And then in the Clinton time frame, that rule was changed, and the moving expense deduction was moved off of Schedule A. It was turned into an adjustment to income. And when it became an adjustment to income, it really opened up moving expenses as being a deduction available to a much greater number of people, because you no longer had to itemize to benefit from them. But at the same time, they took away many of the most common expenses and said these are no longer deductible. And examples of the types of expenses that are no longer deductible include house hunting expenses, real estate sales expenses, temporary living expenses, and meal expenses while traveling and living in temporary quarters. None of those are allowed as moving expenses tax-free. An employer may still give these benefits to an employee, but if the employer does pay these benefits for an employee, again, the employer has to gross up the employee's pay by the cost or value of those benefits paid for the employee. Now here we do have a listing of some of the non-taxable fringe benefits. Some fringe benefits that are not taxable or are minimally taxable if certain conditions are met. And examples of these include services provided to you by your employer at no cost to your employer. Qualified employee discounts. So say if you work for Nike and they let you shop at the Nike employee store and purchase Nike apparel at a big discount, that's allowed as a tax-free fringe benefit. Working condition benefits that are the cost of property or services you could deduct as a business expense if you had paid for it. Examples include business use of a company car and subscriptions to business magazines. So what this is saying is if your employer provides you with a company car and says you can use this company car only for making business mileage on behalf of us as your employer, then that won't be a taxable fringe benefit to you, because the cost of operating that car for business purposes would be deductible to you anyway. If you owned your own car, used it for business, you could record that expense and claim it on Form 2106. So if it's deductible on 2106 and the employer pays it for you or provides it for you, that means it's a non-taxable fringe benefit. Number 4, certain minimal value fringe benefits. Examples of minimal value benefits are an occasional cab ride paid for by your employer when you must work overtime, or local transportation benefits provided because of unsafe conditions and unusual circumstances, or meals provided at eating places operated by your employer if the meals are not provided at below cost. And we also have qualified transportation fringe benefits that are subject to specified conditions and dollar limitations. These also can be tax-free fringe benefits, and they include a ride in a commuter highway vehicle between the employee's home and place of work, transit passes, qualified parking, qualified bicycle commuting reimbursement. There are limits on each of these, though. It isn't just a blanket policy. The IRS does have a limit on the value or the amount of money that an employer can provide towards these fringe benefits for transportation. For 2012, are as follows. $125 per month for combined commuter highway vehicle transportation and transit passes. $240 per month for qualified parking, and $20 per qualified bicycle commuting month. So it's just a little token amount there if you happen to ride a bike. Portland, Oregon, where our school is located and where I live, is a really, really big bicycling city. So if you happen to live in a community where bicycling is common, you might have a few employers giving that qualified bicycle commuting expense. Qualified moving expense reimbursements are also tax-free, and the qualified moving expenses that an employer can still pay for an employee are the physical cost of packing and shipping household goods, up to 1 month of free storage, and the cost of physically moving the employee and the employee's family from their old home to their new home. Any expenses above and beyond that are taxable benefits, but those specific expenses can still be tax-free. If an employer paid tax-free benefits for an employee, you should see a code P on the W-2 in that box 12. So if you remember that list of codes I gave you, code P would represent how much moving expense the employer paid for the employee. Also, the use of on-premises athletic facilities, if these are substantially all used by employees and their spouses and children only. So if you happen to work for an employer who has a gym on site and you are able to use that gym, that is something the employer is allowed to provide for you tax-free. But if they give you a membership to a gym, that's not tax-free. And number 8, qualified tuition reduction an educational organization provide to its employees for education. That too is considered to be a tax-free fringe benefit. If you want more information about employee benefits, you should go to publication 15B. This is the IRS's publication. It's really intended for employers, but I think as a tax preparer, I have actually found this to be one of the more revealing and interesting publications that the IRS has, and I would put that on my list of must-reads for all tax practitioners. Now, I did pull a table out of that publication 15B. It's table 2.1. And this table gives you a description of many of the different types of fringe benefits an employer might give to employees, and it describes the tax treatment that is provided for under the law for that particular fringe benefit. Is it subject to Social Security tax but exempt from income tax, or vice versa? This is where you go to see how much or what types of benefit can be given tax-free and which types of benefits are taxable. The next topic we're moving on to, still in the wage category, is tip income. All tips you receive are income and are subjected to income tax. If you receive tips, you are required under the law to keep a daily tip record. You are required to report your tips to your employer, and you are required to report all of your tip income on your tax return. You can record your tips in either of 2 ways. The first one is to actually keep a tip log. Just basically a book where you're writing down your tips each day and recording that information. The other, if your employer provides an electronic record, is to print out and keep a copy of that electronic record instead. So why report tips to the employer? Well, firstly, the employer is required to do Social Security and Medicare withholding on those tips for you, and if you don't tell your employer how much tip you got, then they don't know how much tax to withhold. The other is so that the employer can correctly report your total earnings to Social Security on your W-2. And the third reason is, well, the law requires it, and if you don't, you can be subjected to penalties. In fact, just this past week, I got a call from a former client. He's been in Nevada for over a decade. And apparently, he's been working and getting some pretty decent tips and not reporting them because he just received a letter from the IRS saying he owes $17,000 for failure to report his tips. So it might be that I'm able to help him. It may not be. He has informed me that he does have a tip log. So I've said to send the IRS letter, a copy of the return he filed, and that tip log, and I'm going to do an analysis and tell him whether or not he owes that $17,000. But I bet he does. We'll see what I can do to help him. Now, allocated tips. Let's talk about those. Allocated tips are amounts your employer assigns to you in addition to tips that you reported. Your employer is required in certain situations to allocate tips to you if you fail to report at least 8% of your total food and beverage sales as tips. So if you've got a certain amount of revenue coming in, percentage-wise, 8% of that revenue should be coming into you as tips. And the exception to that would be maybe you work in an establishment where tipping is just not common, like Starbucks or a fast food restaurant. There would not be a tip allocation going on in that type of place. But if you're working in a classy restaurant, in a hotel where tipping is customary, most people tip a low of 10% and a high of 20%. I mean, that's the average range, and 15 might be considered a moderate medium. So if you're not even coming up with 8%, you're either really bad, you're working in a not-so-great establishment, or you're not reporting all of your tips. And so the IRS works off of the assumption that you're probably not reporting your tips. And if you have not reported 8% of your tips to your employer, then the employer is going to have to do a calculation and allocate tips to you. I'm going to give you an illustration here of how that might work. We have a character named Betty, And for the year, she received a W-2 from her employer, which shows the following information. Box 1 wages shows $7,000, and Box 1 is comprised of two figures. One is her base wage for the year, which was $4,000 of wage income, and the other part is $3,000 of tips that she did report. So her W-2 is showing $7,000 of wages, $4,000 of the wages came from hourly rate, and the other $3,000 came from tips. But on her W-2 shows a number in Box 8, and that number is $4,500. I need to tell you that the number in Box 8 is not included in Box 7. So if Betty does not have a tip log, she's going to have to report $7,000 plus $4,500 on line 7 of her tax return. But Betty was very careful throughout the year, and she did actually keep a tip record. Her tip record shows that she received $5,000 of total tips for the year, but Betty was very naughty and reported only $3,000 of tips to her employer. Her W-2 identifies the $3,000 of reported tips in Box 7. Had Betty, however, reported the full $5,000 that she'd actually received, Box 7 should actually have $5,000 in it rather than $3,000. So just hearing Betty's information, the story that she's providing, we automatically know she has $2,000 of tips she didn't report, and under the law we know she's required to report that, and she's also now going to be required to pay a tip tax because she didn't report it. So let's take a look at this little table I did to summarize things. The actual tips that Betty received is $5,000. The tips she reported to her employer is $3,000. The tips reported on the W-2 are $3,000, and the total amount of wage income reported on the W-2 is $7,000, leaving $2,000 of unreported wages tips. And that same W-2 also shows allocated tips of $4,500. So looking at Betty's 1040 form, the amount that should be reported on line 7 of the Form 1040 is $9,000, even though Box 1 of the W-2 shows $7,000. So let's go over and take a look at how we actually finish up Betty's 1040 and what her W-2 looks like. As I've said, her W-2 shows $7,000 in Box 1, and it's comprised of the number in Box 3 plus the number in Box 7. And over off on the side, we have this allocated tips amount. Betty's in trouble. She can't hide the extra $2,000 she didn't report. Maybe that was her plan. I'll only report some of my tips, and maybe I won't get an allocation, and I'll get away with it. But she did get an allocation, and now she's going to have to file a tax return that at the very minimum acknowledges the $2,000 she didn't report. And she doesn't need to report the full allocation because she has a tip log that proves the amount she actually received. So when Betty reports her wages on her tax return, she's going to go over to line 7 and enter $9,000. The $7,000 from the W-2 plus the $2,000 of tips that she should have reported and didn't. $9,000 goes on line 7. Moving on to the next page, we're going to look at Form 4137 because whenever you have unreported tip income, you are required to complete Form 4137 to figure the tip tax that you owe. We begin on the 4137 by providing the name and EIN of the employer that she worked for. We then enter the total tips that she received for the year, and that was $5,000. We then enter the amount of tips that she reported to her employer, which was $3,000. And of course, 3 from 5 is 2. 2 is equal to the unreported tips. There's another calculation going here on line 7 and 9, and that calculation is establishing whether or not Betty has maxed out on her Social Security requirement for the year. Clearly she is not. She hasn't earned $110,000. And that calculation is done merely to determine whether all $2,000 is going to be subjected to Social Security tax. And the answer is yes, it is all subjected to Social Security tax. So on line 10, she enters $2,000. She multiplies that by 0.042. And on line 12, she multiplies that by 0.0145. That's her portion of the Medicare and Social Security tax that she owes on $2,000 of tips. The total is $113, and she's going to carry that over to her Form 1040, and on line 57, she will check Box A for Form 4137, and she will enter $113 on the line. Now, apparently her income's so low, she didn't actually owe any other income tax, or just owed a very moderate amount of income tax, but she did have $200 of withholding. We haven't shown you the rest of the formula or the rest of her tax return there. And the final thing we're going to talk about on wages before we take a quick break and move on to investment income is scholarships. There is another form of taxable income that is not typically reported on a W-2, and that's taxable scholarships. A scholarship or a fellowship is usually intended to be tax-free because it's intended to be spent on qualifying educational expenses. But in certain situations, some students receive scholarships that are much larger or even just a little bit larger than their actual educational expenses for the year. And to the extent that educational expenses are less than the scholarship being received, then the scholarship becomes taxable. So what is a qualified educational expense? Well, qualified educational expenses include the cost of tuition and fees required to enroll or attend an eligible educational institution, as well as course-related expenses such as fees, books, supplies, and equipment that are required for the courses at the eligible educational institution. And these items, whatever they are, must be required of all students that are in your course of instruction. So if your course of instruction requires you to have a laptop or an iPad or requires you to purchase art supplies to do various projects, then those would be allowed expenses. But if the course doesn't require those and you purchase them because they make your educational experience a better one, then they wouldn't be qualifying. Scholarship income or scholarship amounts that are spent on non-qualifying expenses are taxable, and examples of non-qualifying expenses include room and board, travel, research, clerical help, or equipment and other expenses that are not required for enrollment in or attendance at the eligible educational institution. I have a quick illustration here for you. Steve's student received a W-2 showing $5,000 of wages paid. He also received a $20,000 scholarship, of which $13,000 was spent on qualifying educational expenses. That means he has $7,000 of scholarship that was basically left over for him to spend on whatever he wanted, possibly even living expenses. So that $7,000 scholarship is taxable, and the IRS wants to see you enter that scholarship as wage income on line 7 of the 1040. They do say, since there is no W-2, that you should identify that number on the line next to line 7. So on the dotted line next to line 7, you type SCH, that means taxable scholarship. You enter the amount of the scholarship, and then you add that scholarship amount to the $5,000 of wage and enter $12,000 on Steve's student's 1040. Password number 2 is Prowler. P-R-O-W-L-E-R. Prowler. The next thing I'm going to do is put up a question for you. The question reads, Jennifer worked part-time at Starbucks and also full-time as a server at Jake's Fish House. She received the following tips during the year: $15 per month for 12 months at Starbucks and $5,000 at Jake's Fish House. Jennifer did not report her tips from Starbucks, but all tips were reported for Jake's Fish House, as they should be. They were properly reported. How much tip income must Jennifer report on Form 4137? This is kind of a nasty question because I didn't really discuss one of the important rules about reporting tips while I was teaching today's class. I've never actually put it in the manual. To know the rule, you either have to read Form 4137 and the instructions for Form 4137, or you have to read Pub 17 where it talks about it there too. So whenever I teach a class or put information into a manual such as the one you see in front of you, that's not the entire story. You shouldn't just say, oh, that's everything there is to know about it because April told me and that's what's in the manual. You still should be relying on resources that are provided to you by the IRS. This particular question that I'm asking you is addressed in those IRS reference materials, but I didn't talk about it in the early part of today's class. The correct answer is 0. And I can see that almost no one picked that. There were a few people who were at 0. Let's go see why 0 is the correct answer. If we go back up to the Form 4137, I want to draw your attention to line 5. It says cash and charged tips you received but did not report to your employer because the total was less than $20 in a calendar month. Well, the instructions for Form 4137 are that this is a form you fill out when you have unreported tip income that's subject to the tip tax. And it happens to be that our character in our story has no unreported tip income that is subject to tip tax. The Starbucks tips that he received of $15 a month are not required to be reported because they're less than $20 during the month. And all of the tip income received while working at Jake's Grill was reported. So under the law, all required tips that are required to be reported were reported, and all of the tips that were received but not reported were not required to be reported. And that's why 0 is the correct answer for that particular illustration. If you want to know more about it, read the instructions for Form 4137 or Hub 17 on tip income. That's where you'll find out that extra information. Now, moving on to the next topic of the day, investment income. Investment income generally includes interest, dividends, royalties, annuities, and short-term capital gains. The definition of it really varies according to what form you're looking at, what tax situation you're looking at, but if you were to just go to IRS and try and define a definition of investment income, essentially IRS is describing all of these items as being investment income. But when you get over to the ability to deduct investment interest, IRS narrowly defines investment income as including only interest and dividends. Because it provides that more narrow definition in certain areas, today's class will focus only on those two types of income, which are reported, of course, on line 8 and line 9 of the 1040. Now, in certain situations, when you report interest income, you are required to attach Schedule B to your tax return. Schedule B is required if your taxable interest or ordinary dividend income for the year is more than $1,500, if you were excluding interest under the Education Savings Bond Program, you had a foreign bank account or trust, or a homeowner paid you interest under a seller-financed mortgage where you are the mortgage holder. You received Form 1099 INT for U.S. savings bond interest for amounts that you reported before 2012, and we'll talk about when that's possible, though it's quite rare. You received nominee interest or ordinary dividends for someone else. You received a Form 1099 INT for interest on frozen deposits. You received a Form 1099 INT for interest on a bond that you bought between interest payment dates. You were reporting original issue discount or OID in an amount that is less than the amount shown on the 1099 OID. And finally, you acquired taxable bonds after 1987 and you chose to reduce interest income from the bonds by an amortizable bond premium. Now, one of the reasons why the form is required but really isn't listed in here is that you have a foreign bank account, and we'll get into that in a couple of minutes. Interest income, what is it? Well, interest income comes from money that you have on deposit in a financial account. It also comes to you as income from money that you loan to others. IRS does go out of its way to point out that some dividends are actually interest, and anytime you have money on deposit in a credit union, the credit union is going to call that interest income that it pays you dividend income. However, it's not dividends, it's interest. So credit union dividend income is always interest. If you open up an account with a bank or a credit union and they give you a gift, that gift may also be treated as interest income. If you receive a gift from a bank valued at more than $10 but you have less than $5,000 on deposit, then you need to report the value of that gift as interest income. If you have more than $5,000 on deposit, you only need to report as interest income gifts that are more than $20. Interest on insurance dividends. Interest on insurance dividends left on deposit with an insurance company that can be withdrawn annually is taxable to you in the year it is credited to your account. However, if you can withdraw only on the anniversary of the policy, that interest is taxable in the year that that date occurs. Also, prepaid insurance premiums. Any increase in the value of prepaid insurance premiums is interest income. And then we move on to interest on U.S. obligations, including U.S. Treasury bills, notes, and bonds. U.S. government interest is reported in Box 3 of Form 1099 INT, and there are two important facts that you need to remember about U.S. government interest. Firstly, U.S. government bond interest, by law, cannot be taxed at the state level. And you may be able to exclude U.S. government interest from your income on the federal return as well if you used that interest to pay for qualifying higher education expenses. And to do that, you would file Form 8815. Married filing separate filing status is not allowed to exclude U.S. bond interest on Form 8815. There are generally three different types of U.S. government obligations. These include Treasury bills, Treasury notes, and Treasury bonds. Series HH bonds are generally issued at face value and interest is paid twice a year. You report the income as you receive it, and Series HH bonds mature in 20 years. Series EE bonds, interest on these bonds is payable when you redeem them. Series EE bonds are issued at a discount. You can choose to report income from Series EE bonds when they mature, which is method number 1 and the method most people use, Or you can make an election the first time you ever buy these bonds to report the interest under Method 2, which is essentially the accrued amount each year. Series I bonds were first issued in 1998, and they are intended to encourage taxpayers to save more by offering inflation-adjustable interest rates. The bonds are composed of two parts. The first part is a fixed rate of return that remains the same for the life of the bond. The second part is a semi-annual inflation rate that can vary every 6 months. Series I bonds mature after 30 years. Installment sale payments. If you sell your property on a contract to receive payments over time, then you have an installment sale. If you fail to provide written terms for the interest amount of a contract sale, then the interest portion of each payment will generally be implied. Interest is taxable when you receive it, so in other words, you cannot choose to give an interest-free loan. There's a couple of reasons why we can't have an interest-free loan. The first reason is if you sell property on an installment sale, let's just say you're selling a house worth $300,000 on an installment sale, and you've made the decision that you're going to do an interest-free loan. One of the benefits for treating it as an interest-free loan is that every single payment you receive could be tax-free. If you're selling your home for $300,000, maybe your cost in it is $100,000, so you have a $200,000 profit on the sale that you're able to exclude because you can exclude up to $250,000 of gain on the sale of your home. You're going to be saying, well, all of the payments I'm receiving on this home are tax-free. But when you sell a home on an installment contract, you're lending money to the person who buys it, and they're having the use of your money. And so a portion of each payment that you receive really should be treated on your return as taxable income and be attributable as interest. Now, even if you weren't selling a home, let's just say you're selling an investment property, a piece of real estate that you hold for investment purposes. The IRS doesn't want you to increase the amount of gain on that sale and have that increased amount be subjected to the lower capital gain rate at the expense of reporting interest income at higher tax rates. So they want you disguising your income and trying to take advantage of a lower tax rate than you really are entitled to. The other reason why the IRS doesn't allow interest-free loans is when we get into gift rules. If we're looking at situations where you might have a very wealthy individual who wants to loan money interest-free to dependents that they have or relatives that they have, basically as a method of transferring wealth. And when you get into the transference of wealth, there are gift tax rules and gift tax returns that have to be filed. And so, again, the IRS doesn't want to see interest-free loans. And if they come along in an audit and establish that no interest was assessed or charged, then they will imply a minimum amount of interest and report that as income to you no matter what. So if you are a beneficiary of an estate, trust, S corporation, or partnership, you will typically receive a K-1. When you receive a K-1, and I do have a K-1 in this manual for you, it's near the end under our classwork and homework assignments. There's a K-1 for Gridirons, Inc. This particular K-1 is issued by an S corporation. You can see it says 1120S. And this K-1 is showing $1,000 of interest income being reported on line 4. If you have a K-1 reporting interest income, that interest income is going to carry to line 8 of the 1040. It has to retain its character and be carried over to the 1040 in that manner. If we go over to the homework assignment, you will see we also have another K-1. This is for a partnership because it's a 1065 K-1. It's reporting line 5 interest income of $1,500 and ordinary dividend income of $100. That income needs to retain its character as well and carry over to the appropriate lines of the 1040 form. So again, if you receive a K-1, you have to remember that the income reported on the K-1 retains its character and goes over to the appropriate lines of the 1040. Original issue discount is a form of interest, and you generally include OID in your income as it accrues, whether or not you actually receive any payments from the issuer. A debt instrument generally has original issue discount when the instrument is issued for a price that is less than its restated redemption price at maturity. OID is the difference between the stated redemption price and the price at maturity and the issue price. So essentially, if you purchase a bond for $900 but the maturity price is $1,000, that means you have $100 of original issue discount built in. State or local government obligations. Generally, interest on obligations used to finance government operations is not taxable on your federal return if the obligations are issued by a state or local government. So let's just say you decide to purchase some California state bonds. those bonds would be issued by the state of California, and because they were issued by a state, the federal government is not allowed to tax them. Most states do not tax their own bonds. So if you are a resident of California and you purchase California bonds, the interest you receive on those bonds would not be taxed by California. It would also not be taxable by the IRS. But if you're a resident of California and you purchase Oregon savings bonds, the federal government would not be able to tax those Oregon bonds, but California would tax them. So you have to look to the individual state laws to see if your state taxes the bonds of other states, but most states do. And I have now on the screen in front of you a 1099 INT. Very rarely will your client ever come to you with a 1099 INT that looks like this. Usually what they're going to bring you is something called a substitute 1099 INT, and that substitute 1099 INT will say Box 1 interest income $100, Box 2 early withdrawal penalty blank, Box 3 interest on U.S. savings bonds $200. And it's your job as the tax practitioner to know what to do with those numbers, even though the substitute document doesn't look like the real 1099 INT. I'm not going to read you all of the boxes for the 1099 INT, but I am going to point out the ones that are usually full with a number in them. They include Box 1. Box 2, sometimes, but not too often, will have a number in it. If you have a number in Box 2, it means that you had a time deposit. Your money was in the bank. It needed to be there for a minimum amount of time to earn a particular amount of interest. And you've come along and you've pulled it out early, and so the bank is penalizing you. And the amount of penalty that you see in Box 2 is deductible as an adjustment to income on the front page of the 1040. But you shouldn't ever subtract Box 2 from Box 1. You report Box 1 interest income in full, and if you have a penalty, you claim a deduction for it. Box 3 is used to report interest on U.S. savings bonds. Box 4 is used to show federal tax withholding. Most of the time, people don't show federal tax withheld on their interest income. You're likely to see federal tax withholding if the bank has started to do backup withholding because the account holder failed to provide a valid Social Security number. Box 6 is foreign tax paid. Box 7 shows the foreign country or U.S. position to which the foreign tax was paid. Box 8 is a relatively new box. It's only been around 3 years now. Box 8 shows the amount of interest income that is tax-exempt interest income. And Box 9 shows the portion of Box 8 that is specified private activity bond interest, and specified private activity bond interest is tax-exempt at the income tax level on the 1040, but it is in addition to income. It is taxable income under the rules for the alternative minimum tax. So if you're completing 6251, or if you have a client who's subjected to alternative minimum tax, this would be an increase to their taxable income on Form 6251. Let's move over now to the 1099 DIV form, but before we start on a discussion of 1099 DIV, I wanted to give a quick poll here. Here is the next poll question of the day. What kind of interest income is reported in Box 3 of Form 1099 INT? The first choice is taxable ordinary interest, which is reported on line 8A. The second option is taxable U.S. bond interest, which is reported on Form 1040, line 8A. The third option is tax-exempt U.S. bond interest, which is reported on 1040, line 8B. And the last one is tax-exempt interest, which is reportable on 1040, line 8B. So again, I think it's important to understand each box on a reporting document like 1099 INT or a W-2. If you read a document that says Box 3 interest is $100, that should mean something to you. You should know what to do with that number and not be relying on your tax software to think its way through that scenario for you. The correct answer is response number 2. Taxable U.S. bond interest is fully taxable on the federal return. It is entered on line 8A of Form 1040. What makes U.S. bond interest special is that it would be a subtraction at the state level. If your state pulls adjusted gross income from the federal return and then begins doing its calculations for state taxable income, starting with federal AGI, at the state level you were going to have a subtraction if you showed U.S. bond interest on line 8A. Well, that's going to be a manual entry for you typically on the tax return. If your software is asking you, hey, what's in Box 3 of 1099 INT, and you enter what's in Box 3, your software, if it's smart enough, may know that it needs to do a subtraction or provide special treatment on the state return. But your software should also know that any amount that's in Box 3 of the 1099 INT is reportable on line 8A. It doesn't get any special treatment on the 1040 at all, with the one exception being that if you use your U.S. bond interest to pay qualifying higher education expenses, then you can file that particular form to exclude the U.S. bond interest from your income. But that form is incredibly rare. I rarely have people who have U.S. bond interest income in the same year they pay educational expenses, but it can happen. Okay, the next topic we're going to talk about is dividends and other corporate distributions, and we're moving now on to the 1099 DIV. 1099 DIV and 1099 INT are required to be issued when $10 or more of income was made to a taxpayer during the year from the payor. If your client received only $5 of interest income for the year from their bank, or only a penny of interest from their bank for the year, they wouldn't get a 1099 INT. There is a threshold amount at which the form is required, and that amount is $10. So let's just take a look here at the 1099 DIV and see the boxes that are showing on here. Box 1A is used to report ordinary dividend income. Ordinary dividend income is reported on line 9A of the 1040. Line 1B is qualified dividends, and 1B is included in 1A. So 1B represents the portion of 1A that is qualified dividends, and qualified dividends are important because they are allowed to be taxed at the lower capital gain rates. Box 2A shows total capital gain distributions. If the only capital gain income you have for the year is capital gain distribution showing on line 2A, then you can make an entry from 2A directly on the 1040 form. And on this form 1040, dividend income, ordinary dividends, are reported on line 9A. So line 9A is where you report ordinary dividends. Line 9B is the portion of ordinary dividends that are qualified dividends. But if you have box 2A showing on your 1099 DIV with a number in it, that number actually carries to line 13. And if Schedule D is not otherwise required, you can check this box. It says, if Schedule D is not required, check here. Well, if the only form of capital gain income you had was capital gain distributions, that's when you can check this little box and enter the amount directly on line 13. But if you are required to file Schedule D for any other reason, the amount shown on line 2A of the 1099 DIV is going to carry to Schedule D before it is entered on line 13 of the 1040. We have line 2B where we enter unrecaptured Section 1250 gain. There will be a number for 1250 gain if you sold real estate that has a recovery or a recapture of depreciation. Section 1202 gain is from the sale of qualified small business stock. Up to 100% of the gain on the sale of certain qualified small business stock may be excludable from your income. Lots of rules that apply to that. It's a very specific type of stock that has to meet specific tests. Usually there's a legal document supporting that. If that's the case, then it may be excludable from the income in part or in full, depending on when the stock was purchased. We also have collectibles gain that is reported in box 2D. And if you have income from the sale of collectibles, then that is subject to a 28% rate of gain. Form 1099 DIV is used to report dividend income. So why am I talking about the sale of stock items in here? Well, typically you're going to show gains from the sale of stock if the dividend document is being issued through a mutual fund. So if you purchase stock in a mutual fund, that mutual fund in turn is investing in all kinds of different stocks, and it's buying and selling stocks throughout the year. That mutual fund will receive dividend income, it will receive qualified dividends, it will receive capital gain distributions, and it will also have income in certain situations that's from the sale of items that are subjected to special rates of tax. Either they're not taxed at all because they were Section 1202 gain, or they're only partially taxable because they were 1202 gain, or they're going to be subjected to a higher than normal rate of capital gain tax because it was a sale of a collectible, or they're going to be subjected to a specialized rate of tax because it was a recovery on depreciation. We also have non-dividend distributions. A non-dividend distribution is a return of your cost in an item, and in most cases non-dividend distributions are not taxable. Federal income tax may be withheld and is required to be withheld if you have not provided the Social Security number. If any of the dividends are from foreign companies, foreign investments, then foreign tax may have been paid to a foreign country, and the amount of foreign tax paid will show in Box 6. If Box 6 on the 1099 DIV or the equivalent box on the 1099 INT is showing an amount, and that amount is less than $300 for single filer or $600 for joint filers, you can claim the foreign tax credit without filing Form 1116. But as soon as the amount goes over $300 or $600 on a joint return, Form 1116 is required if you want to claim the foreign tax credit. So there's more information in here if you want to read more about those box numbers. But the only one I'm going to stop and pause and give you an illustration on is that concept of a tax-free dividend. And it might be helpful to think of a non-taxable distribution as something like a rebate. A rebate is not taxable to you. Let's suppose you go to the store and you buy yourself a television, and at the time you buy this $3,000 television, the manufacturer is offering a $300 rebate. So you pay $3,000 for the television, you fill out the rebate form, and a couple of months later you get a $300 check in the mail. That $300 check to you is not income. It's basically a refund of your initial investment in that television of $3,000. And so your cost in the television is now dropped from $3,000 down to $2,700. The similar effect can be looked at with the return of tax-free dividends. Let's just suppose you go out there and you purchase stock, and this example is on the screen in front of you. You paid $100 for a share of stock, and you receive a return of capital in the amount of $70. That $70 return of capital is not income to you, but it does reduce the basis of your stock to $30. If you later turn around and sell that stock for $120, then your gain on that sale will actually be $90, not the smaller amount that you would think would only be $30. Insurance dividends. If you receive dividends on an insurance policy that are a return of your premiums, they are not taxable. And then the final thing for interest and dividends that I'm going to talk about briefly here is the nominee concept. It's not at all uncommon for two individuals to share a joint account, but typically when a 1099 INT or 1099 DIV is issued, it's going to be issued to the first Social Security number that appears on that account, even if the Social Security number is not representative of the person who truly is the owner of the assets. For example, you might have a joint bank account with your mother, and the only reason your name is on the account is so that if she becomes unable to care for herself or is incapacitated in some way, she wants you to have free access to her money so that you can use it for her benefit. Or when she passes away, she doesn't want anything interfering with your ability to access that money, so she puts your name on the account. But it happens to just be that your name is the first name on the account, and so the 1099 INT comes to you rather than to your mother, to whom the money belongs. Well, if you get a 1099 DIV with your Social Security number on it, you have to do something about it. And what you have to do is you have to report the income on your return. But is it fair for you to pay tax on income that's not yours and really belongs to your mother? The answer is no, and so that's why we have this nominee distribution concept in place. And I have an illustration here of how that might work. We have two sisters named Galadriel and Arwen, and they are joint owners in a savings and investment account with Rivendell Community Bank and Two Towers, Inc. Forms 1099 INT and DIV were both issued to Galadriel by these financial institutions, even though all of the money and interest in these accounts belong to Sister Arwen. Now, independently, Galadriel also received a separate 1099 INT from Rohan Bank, and the Rohan Bank 1099 INT is truly her money. So what's going to happen? Well, we have Galadriel receiving a 1099 INT from Rivendell Bank for $1,200, except the money really belongs to Arwen. And then on the next page, we have another 1099 INT from Rohan Bank, but this really is Galadriel's money. And then we also have a 1099 DIV from Two Towers, showing $500 of ordinary dividend income, but the Two Towers dividends really belong to Arwen, even though they've been issued in the name and the Social Security number of Galadriel. So what can Galadriel do about that? Well, she can do a couple things. She's going to fill out a Schedule B. And on the Schedule B, she's going to indicate all of the interest and dividends that were paid out to her during the year based on her receipt of 1099 DIVs and 1099 INTs. She's going to acknowledge Rivendell Community Bank. She's going to acknowledge Rohan Bank. And then she will do an interest subtotal. And here you can see that's $2,000. She will then indicate that there is a nominee distribution going out to Arwen in the amount of $1,200. And $1,200 will subtract from $2,000, and Galadriel will then enter $800 of interest income on line 4 of her Schedule B, and that is the amount that she will carry to 1040 and enter on line 8A. On the bottom of the Schedule B, we can see we also acknowledge the dividend income from Two Towers, but we show that all $500 of dividend income is being nominated out, and the amount of income carrying to line 9 of her 1040 form will in fact be 0. Now I did want to point out there's a couple of extra things going on at the bottom of Schedule B. These are mandatory questions that have to be answered for all filers, and they have to do with foreign accounts and trusts. And in just a minute we're going to move on to a discussion of foreign accounts and trusts because they've become a focal point of the IRS. In Galadriel's case, the answer is she does not have any foreign accounts or trusts, so we've checked no. Now, Galadriel's not done. She can't just nominee out on her tax return and not do more than just that. If she's nominating out, she is now responsible for issuing a 1099 INT to her sister to show her sister or report to the IRS the amount of income her sister should now be reporting on her own return. So Galadriel needs to issue a 1099 INT to Arwen. And so now we have Galadriel as the payer, Arwen as the recipient, and Arwen is going to receive a 1099 INT in her name for the amount of interest income she is required to report. And by the same token, Galadriel will issue to Arwen a 1099 DIV for the amount of dividend income that Arwen is required to report on her return. So that is the conclusion of the discussion on dividends.
Please pause the lecture video and complete this session's classwork. Enter your answers into the LMS when you have finished. Then resume the lecture for the classwork review. Okay, welcome to the Session 3 classwork review. You needed to fill out forms 1040 and 4137 to complete this problem. John Walker and his wife Donna, who is blind and has no other income of her own, live at 635 Northeast 10th Avenue, Portland, Oregon, 97212. John is a bartender. He regularly receives cash tips and does not report them to his employer. John does not keep a tip log. John received a substitute 1099 INT with Box 1 interest of $300, Box 3 interest of $200, and Box 8 interest of $50. He also received a substitute 1099 DIV with $200 of ordinary dividends in Box 1A. We give you John's W-2 and ask you to prepare the Walker's federal return. So let's take a look at the 1040. We enter John and Donna's information here, name, social security numbers, address. We click the box here for married filing joint. We check the box on 6A and 6B to mark an exemption for each of them. So 2 total exemptions, that is carried down to box 6D. And then on line 7, we have $30,000. Now, you might be saying, how did we come up with the $30,000? Maybe you figured that out and maybe you didn't. But let's take a look at it. Take a look at the W-2. In box 1, we have $25,000, which is his reported tips and wages for the job at Tender's Bar. But we also have box 8 here, allocated tips. Since John did not report his cash tips to his employer, they have an amount that they allocate for what they think a server would make. And since he did not keep a tip log and is unable to dispute that number, he is going to have to report the whole $5,000 on line 7 as income, and he's also going to have to fill out Form 4137 to pay his share of Medicare and Social Security tax on that amount. Let's move on to box 8A. That's $500. That's interest, the box 1 interest of regular interest, and the box 3, which is bond interest. Both of those are fully taxable on the federal return, so we enter the $500 on line 8A. We also told you that you have box 8 interest of $50. That is tax-exempt interest. It's not subject to tax, but it is reportable, and we do that on line 8B, so we put the $50 there. We also told you that John had box 1A ordinary dividends of $200. Dividends are reported on line 9A. We've put the $200 there. So you add up the 30, the 500, and the 200, and then you end up with total income of $30,700 on line 22. We have no adjustments to income, so we end up bringing the $30,700 down to line 37, and that is the total adjusted gross income. We go to page 2. Page 2, line 38, picks up where line 37 left off, so we carry the $30,700 from page 1 over to line 38. The next thing that we do is we look here at 39A, and we have to see if either of the walkers met the requirements for being over 65. Neither of them did, but Donna is blind, so we do put a checkbox in the blind and put a 1 here in 39A. Next thing we do is look at the standard deduction on line 40. We go over here, married filing joint. They're going to start out with $11,900, and we're going to add another $1,150 for Donna's blindness and end up with $13,050 for their standard deduction. We subtract the standard deduction from line 38 adjusted gross income and end up with $17,650. Next thing on the return are exemptions. We already know that on page 1 we have a total of 2 exemptions for the walkers. So we have 2 times $3,800. We enter on line 42 $7,600 for the exemptions. We subtract that from the previous number, and we end up with line 3 $10,050 of taxable income. The next thing you would have done is gone to the tax tables in Pub 17 and looked up what you would have had for tax for married filing joint at that income level. And you should have come up with $1,008. We bring that number down to line 55. Here's where we're going to figure out what John's tax is on his non-reported tips. Line 57, unreported Social Security and Medicare tax from Form 4137. And you want to make sure and put a check mark in that box to show the IRS where that additional tax is coming from. So let's take a look at Form 4137. Look at line 1, put John's name and his Social Security number in, as he is the person that received the tips, and then they have a number of lines here for where the tips are coming from. John just had one job at Tender's Bar, so we only have one line filled out. But let's say you have a taxpayer that has 3 different jobs, and they receive tips at all of them. Then you would enter the additional information on lines B, C, D, etc. Put the employer's identification number in here, and we got that right here from the W-2. Column C says total cash and charged tips you received, including unreported tips. And you may wonder how we came up with $7,000, because we said that John didn't report any cash tips to his employer. But there can also be tips that come through on charge slips. And the employer is going to know about those and be able to pull those out, which they have done in Box 7 of the W-2. So if you add up Box 7 and Box 8, that's where you get the $12,000. In column D, there's the $7,000 that they reported in Box 7. Bring the numbers down, this would be if you had more numbers in here, you'd add them all up and put the total here. On line 2, which is total cash and charge tips you received in 2012. Line 3 is the total amount that was reported through the employer. Line 4 tells you to subtract line 3 from line 2. So if you subtract 7,000 from 12, that's where you get the $5,000 of unreported tips. And that's the amount that we are going to have to figure out the Social Security and Medicare tax on. Bring it down to line 6. Now here on line 7, this is a big number. It's the maximum amount of wages a person has to pay Social Security on during the year. And for 2012, it's $110,100 in income. Once you reach that level, you no longer have to pay Social Security tax on anything above that. We put in John's total income on line 8, and we can see he's well below that threshold. But this is a way of checking that you're not overpaying. So you take the $110,100, subtract out the $25,000 of wages, and John still could earn $85,100 in wages that he is required to pay Social Security tax on. So since this number, $5,000, is below that, we're going to have to figure out the tax on that amount. You take the $5,000, multiply it by 0.042, which is the Social Security tax rate. For the employee, we come up with $210 when you do that. On line 12, it tells you for Medicare tax to multiply the amount on line 10 by 0.0145. When we do that on here on line 12, we enter 73. You add lines 11 and 12 together, and you end up with $283. Also tells you to carry that to line 57 on the 1040, which we have done. So the tax on his income, his wages, then the tax on his unreported tips, the total for that is $1,291. Next line, 62, is the amount of taxes that were withheld from his wages. You find that in box 2 on the W-2, and so we've taken the $2,000, entered it there. No other tax or credits that apply to this return, so we go ahead and bring that total down to line 72. Now we subtract the amount of tax, $1,291, from the amount that was withheld on the W-2, and we come up with $709 in a refund for the walkers. And that is the end of the classwork review for session 3. To complete this session, number 1, take the password test in the LMS. Number 2, complete the homework assignment and enter your answers into the LMS. And 3, complete the quiz and enter your answers into the LMS.
Password number 3 is EOWYN, EOWYN.